Now, the next thing with regard to the currency strength indicator for TradeStation is really for you to decide as a forex trader how you are going to use it. What tactical approach are you going to take to market? You may be more comfortable trading reversals, or you may prefer to jump on an existing trend. And if that's the case, then how do you use the currency strength indicator for those two tactical approaches to trading forex? And as in everything in trading, it's all about risk and reward. Clearly, if you get into a trend earlier, then that is going to have a bigger payoff for you because you're in at the start of the trend. So, for example, if we take the dollar here and the yen here, very strongly overbought, very strongly oversold. If you had got into the trend at this point, this trend is now developing very nicely. You can see it developing on the 3-minute here. It's developing on the 5-minute, and it's also developing over here on the 10-minute. So what we're seeing here is this trend, which started in our faster time frame, is moving very strongly into the 5-minute and is also through into the 10-minute. So this is a really nice trend that's developing in real time. Now, of course, if you got in at the top here, you have already taken advantage of perhaps 50% of that trend. It's already passed. There will be traders who are waiting to jump in now. Now, this is the decision you have to make. Are you, as a trader, looking constantly for the overbought and oversold regions? And I have to profess that is my personal preference, but only because I like to get in early, and I'll explain why in a moment. When you're up at this level, there is no guarantee that this currency is going to roll over straight away. But as I mentioned in previous videos, this market is one of mean reversion. In other words, currencies cannot stay overbought and oversold forever. They have to reverse. That is their life cycle, if you will. It's a sinusoidal cycle where it's a constant rhythm of moving higher and lower and higher and lower in this overbought, oversold cycle. So you can be assured at some point it will come off the overbought region and start to sell off again. What you can't be certain of when that is going to happen. What that means is if you're going to trade overbought and oversold regions, in other words reversals, you have to have two things. First of all, you've got to be patient because this may not happen straight away. In this case, it happened pretty quickly. And certainly in the case of the dollar, it reversed almost instantaneously, almost as soon as it got into the overbought region. But there's no guarantee that is going to happen every time. It also happened down here, funnily enough. That actually reversed up very quickly, almost V-shaped. But generally speaking, what you'll find is the currency will be much more like this. It will get up here, it will flop around a bit, up and down, and then it will decide to move. So two things. First of all, you have to be patient to trade reversals. Secondly, you also have to put more risk on the table because if you're going to trade reversals, your stop loss has to be much wider. You cannot have a tight stop loss if you're going to trade reversals purely because you have to allow for this buffering of price which goes on all the time at these regions and then before the trend lower or the trend higher begins. So it's an important consideration. None of us are particularly patient, but if you have patience in your psychological profile, perfectly fine to adopt that particular tactical approach to trading. And the currency strength indicator really gives you this in spades because it tells you when these currencies are reaching overbought and oversold. Clearly, obviously, you go and look at the chart. You're looking for support and resistance regions. If you're a volume trader, you're looking at volume price analysis to give you that heads up in terms of buying or selling and so on and so forth. But this just gives you the heads up as to where to go and hunt out those opportunities. So those are the issues with reversal trading. They come at a higher price because you have to put more money on the table, and secondly, you require patience. The payoff, of course, is you get into the trend early. So you're maximizing your trend here. You're taking all this money out of the trade. If you're a trend trader, you've got decisions to make. Now, clearly, as a trend trader, the advantage from a risk perspective is you put much less money on the table because your stop loss can be that much tighter because the trend is already underway. To use the train analogy again, the train's left the station, you're jumping on something that's already underway, it has some momentum, and therefore your stop loss can be that much tighter. So there's less risk on the table. Of course, the quid pro quo is that you've actually given up a lot of this trend already. So if you're jumping in late here, for example, then you're going to get something out of the trend, but you're certainly not going to get 100% or as much as possible out of it. You're going to take a chunk out of it, maybe a third out of it, something like that. And the next question, of course, is, well, where do you get in? Well, if we take the 10-minute here, these have not crossed yet. Now, a lot of traders use the currency strength indicator in that way. What they'll do is they'll wait, for example, over here on the 3-minute, the dollar was coming down nicely, the yen was rising nicely, had a bit of a reversal there, now it's carrying on up again. So they would get in on the cross. You've got a similar situation here. We've got a scenario here where we've got the cross developing, so we've got the yen rising, dollar falling. And, that might be an opportunity. You might well decide on the 10-minute time horizon, I'm expecting a cross. In fact, as I'm speaking, it's literally jumped up there, pretty much almost crossing, just touching there. You may decide that's enough for you. You may decide to get in a little bit early. You may wait for the cross to develop. But the principle is that you are jumping into the trend that is already underway. So it's an interesting debate. It's something that you need to consider yourselves. These levels here, this 80 and 20, it's really just for guidance. It's not a signal per se to say, yep, it's at that level and therefore it's going to reverse. It's just a guide to give you some indication of when a currency is approaching that region or at that region or has exceeded that region. When they get very deeply into overbought, as the Canadian did here, up into the 90-95 area. Similar down here with the New Zealand, very deeply oversold down here. You just have to wait, be patient. If you're reversal trading, as I say, you've got to be patient. Once the trend starts to develop, then as a trend trader, you're jumping on the trend, much tighter stop loss, and off you go, and you're waiting for this to cross now and continue this buying of the yen, which we're seeing quite strongly across this time window, and the selling of the dollar, which is continuing also. So a really nice trade developing there, and that would be a nice straightforward trade to take right now. And of course, let me talk about something. In fact, I'll do in the next video. I'm just going to talk about something else about the CSI as well. So I hope you've enjoyed that particular video. Thanks for watching. See you again soon, and bye for now.